Hey everyone, welcome back to the channel. Today is January 28th, 2026, and the Bank of Canada just announced their first interest rate decision of the year. Spoiler alert, they're keeping rates at 2.25%. If you're wondering what this means for your mortgage, your savings, and the Canadian economy, especially the CUSMA negotiations looming, you're in the right place. Let's break it down right now. Bank of Canada has held the overnight rate steady at 2.25%, exactly as economists predicted. I honestly didn't think anything was going to change either, so honestly, it wasn't a huge surprise. This is the second consecutive hold after a series of aggressive rate cuts throughout 2024 and 2025. But here's what everybody's really talking about. We got Governor Tiff Macklem says the bank is prepared to move rates in either direction, so that could be up or down, depending on how things play out. So with the CUSMA, so that's Canada, US, and Mexico agreement renegotiations starting, and Donald Trump threatening 100% tariffs. I don't know what to believe anymore about that. There's a lot at stake, obviously. So stick around because we're going to explain everything you need to know about the rate cuts and what this one means today. So let's get some context first. The Bank of Canada's policy rate has been on quite a journey. It peaked at 5% back in mid 2023 when inflation was running hot and the bank was aggressively trying to cool the economy. Then, starting in June 2024, Governor Tiff Macklem and the Governing Council began slowly dropping the rates. Then, starting in June 2024, Governor Tiff Macklem and the Governing Council began cutting rates as inflation came back down towards a 2% target, which was nice to see. Between June 2024 and October 2025, we saw 9 consecutive rate cuts, bringing us from 5% all the way down to 2.25%. That's a massive 2.75 percentage point drop in just over a year. The last cut happened in October of 2025 when the rate was reduced by 25 basis points, which was surprising to see at the time because we weren't expecting any more rate drops at that time. And obviously the bank said, rates were about the right level. Then in December they paused, and now today we're, holding again. And now today in January they've paused again. Now, this is signaling that the bank believes we've reached an appropriate level, at least for now. But there's a huge caveat, and it has everything to do with trade. So why did the bank hold rates steady today? According to the announcement and monetary policy report, there are several key factors. So first, we got economic uncertainty is at extreme levels right now, and that has been building over some time. The bank statements explicitly says, uncertainty remains elevated. Why? Because of what's happening with the CUSMA, Canada, United States, Mexico agreement. So the CUSMA is up for review this year, and it's basically what shields most Canadians' exports from U.S. tariffs. Over the weekend, President Donald Trump, the big orange man, threatened to impose a 100% tariff on Canada imports if we proceed to trade deals with China. So this is like very scary stuff. It could change quite quickly. Treasury Secretary Scott Bessent doubled down on this, saying Canada could face those tariffs if we enter a free trade agreement with Beijing. Now, this matters because over 91% of Canadian business leaders say their biggest risk right now is a poor outcome in the CUSMA negotiations, and they're already feeling it. 79% of businesses say they've either cut their workforce or plan to in the next 6 months. So that is very scary stuff for all Canadians. So second thing we got is inflation is sitting right around the bank's 2% target. December's headline CPI came in at 2.4%, up from 2.2 in November, but economists point out this was distorted by last year's GST holiday comparison. The core measures that the bank really focuses on is decreased CPI median dropped. The core measures that the bank really focuses on and actually decreased. So the CPI median dropped to 2.5 from the 2.8%, and CPI trim fell to 2.7 from 2.9. Third thing is the job market is showing mixed signals. While December added 8,200 jobs, the unemployment rate jumped from 6.5 to 6.8% because more people entered the job market looking for work, which also can become a little bit scary if you're looking for jobs out there. The economy also contracted in October 0.3%, mainly due to manufacturing weaknesses. So the bank is basically saying we're watching everything closely, but we're not moving yet. And this is going to be a big thing, and I think they're going to be watching things very, very closely for the months to come. And here's where it gets really interesting. In his prepared remarks, Governor Macklem made things very clear. So the bank could move rates in either direction. And he said, and I quote, while council judges the current policy rate is appropriate based on our outlook, the consensus was that elevated uncertainty makes it difficult to predict the timing or the direction of the next change in the policy rate. Okay, so let me translate that. If the trade war with the US escalates and pushes Canada into recession, they'll cut rates. If tariffs push inflation up and the economy overheats, they might raise the rates. Most economists are predicting rates will stay at 2.25% throughout most of 2026. The Reuters poll showed nearly 75% of economists expect the bank to hold through the entire year, but some like National Bank are saying we could even see hikes by late 2026 if the trade situation stabilizes and inflation picks back up. The key phrase from the bank today is that they see the economy continuing to adjust to a new trade landscape. Businesses are reconfiguring supply chains, seeking new markets, and workers will shift into the new roles. That adjustment will take some time. All right, so what does this all mean for your wallet? For mortgage holders, if you have a variable rate mortgage, your rate stays exactly where it is. No changes to your payment. If you're coming up for a renewal on a fixed rate mortgage, here's the reality. Rates are significantly lower than the peak in 2023, but they're likely to stay around current levels for a while. So if you locked in a ultra low rate in 2021 to like 1.5 to 2%, you're probably facing a bit of a shock at the payment renewal, potentially an increase of 40% or more. But if you've been watching, what's happening in the market, you know that this was coming up, right? So this is not going to be much of a surprise for some savers. So interest rates on saving accounts and GICs will remain stable. So while they've come down from the peaks we saw in 2023, you can still find decent rates, definitely better than the near zero rates during the pandemic, right? And for the economy, the bank is essentially saying the economy is in a holding pattern. Real GDP growth is expected to be modest. So most forecasts are in the 1.4 to 1.9% range for 2026, depending on how the trade situation plays out. Vanguard Canada is calling for a 1.6%. Deloitte is saying 1.5%, and BMO is more optimistic at the 1.9%. But that all assumes no nasty surprises on the trade front. Now, what does this mean for job seekers? The labor market is soft right now. So business sentiment surveys show companies are concerned in pulling back on hiring. If you're looking for work, it might be tougher than usual, and that could persist through the first half of the year. All right, so here's the bottom line. Everything hinges on the CUSMA agreement. The auto sector is particularly vulnerable, at 72% of Canadians worrying that the new vehicles prices could spike if CUSMA protections disappear. So keep that in mind for new cars. Agriculture and agri-food producers are on edge because most goods currently move duty-free. The Canadian Chamber of Commerce points out that Canada, the US, and Mexico together account for nearly a third of global GDP. If the CUSMA falls apart or gets significantly weakened, we're not just talking about higher prices and job losses. We could be looking at a full-blown recession. Some economists think the CUSMA will be preserved mostly intact, with negotiations extending through 2026 and keeping the status quo. Others, like Oxford Economics, predict targeted 10% tariffs on steel and aluminum will remain, but most other tariffs will be removed by the third quarter. Now, RBC's chief economist, Francis Donald, warns not to focus too narrowly on the negotiations themselves, and any country can opt out of the CUSMA within just 6 months. So within just 6 months notice, so uncertainty will persist regardless. So there you have it. The Bank of Canada is holding rates at 2.25%. Inflation is close to target, but massive uncertainty about trade makes the outlook extremely murky. The central bank is keeping all options on the table. They could cut, they could hike, or they could sit tight for a long time. The honest truth, to me, nobody really knows what's going to happen next, and it all depends on how these CUSMA negotiations go. Whether Trump follows through on increasing our tariff threats, and how resilient is the Canadian economy. And I think we need to pull in together and be shown as one and push through this, and how resilient the Canadian economy proves to be. If you found this helpful, smash the like button. I'm going to bring you more updates like this every time there's a rate drop. And let me know, how does this affect you? Are you looking for a job currently? Are you waiting for rates to drop to buy your new house? Thanks for watching, and I'll see you in the next one. Have a great day.